we're going to tackle a huge question. Is that old playbook for retirement savings totally broken? Let's find out.
All right, here's the game plan for today. We're going to start with the old rule book, the retirement advice we've all heard. Then we'll dig into the modern dilemma with bonds and why that's a problem. After that, we'll explore a different path, something called FIAs. We'll look at how they protect you, how they grow, and what the trade-offs are. Then we'll put FIAs and bonds head-to-head with some data. And finally, we'll wrap it all up with a balanced view of the whole picture. Let's get into it.
Okay, Section 1, Retirement's Old Rulebook. So, let's kick things off by talking about the absolute bedrock of retirement saving. This is the simple, two-part strategy that financial advisors have been recommending for decades.
You know the drill, right? For as long as anyone can remember, the strategy has been super simple. Stocks, they're your gas pedal, your engine for growth, the thing that pushes your portfolio forward. And then you have bonds. They're your brakes, your airbags, there to protect you when the road gets a little bumpy. It's supposed to be this perfect, effective 1-2 punch.
And this chart right here, man, it just lays it all out. This is exactly why that was the go-to advice for so long. Just look at that soaring line for stocks. If you put $1 single in back in 1927, by 2016, it would have turned into over $5,000. It's just incredible growth. Now look at bonds. That same dollar, it only grew to about 125. The difference is just staggering. This is the proof right here behind that whole stocks for growth mantra.
But here's the million-dollar question. What if that safety part of the equation, the bonds, what if they aren't as safe as they used to be? And that, right there, brings us to a really modern problem for anyone trying to plan for retirement today.
So the research breaks this whole issue down into 3 really clear stages, and they call it the bond dilemma. So step 1, a huge reason bonds did so well in the past is that interest rates were on this long, slow slide downwards for decades. Step 2, we've now hit the bottom, or something very close to it. Yields are near historic lows, so there's really not much more room for them to fall. And that leads to step 3, the big risk. What happens if rates go up? Well, if that happens, bond investors could actually face capital losses. The safe asset suddenly doesn't look so safe.
And you can see the whole story right here in this chart. Just look at that long downward slope on the right side. That shows exactly how dramatically bond yields have fallen, especially over the last 30 or 40 years. The party was great while it lasted, but the conditions that fueled all those amazing past returns, they're gone. And that creates a huge risk for what's supposed to be the safe part of your portfolio.
Okay, so if the traditional safe road is looking kind of bumpy and full of potholes, maybe it's time to check the map for a different route, right? And that's exactly what the source material does. It suggests exploring an alternative path, one that's really built for the financial world we live in today. And this alternative is called a Fixed Indexed Annuity, or FIA for short. Now, this is important. It's not a direct investment in the market. It's actually an insurance contract. And it's specifically engineered to tackle 2 of the biggest worries in retirement. How do you protect the money you have while still giving it a chance to grow?
I think this visual explains the idea perfectly. Imagine equities or stocks as that really bumpy, high-altitude path. High risk, but also high potential reward. Then you've got traditional fixed income, like bonds, as that lower, flatter, safer path. What the FIA tries to do is create a third option, a smoother middle road. The goal is to control that scary downside risk while still trying to capture a piece of the market's upside.
Okay, but how does this thing actually work? How can you possibly get growth that's linked to the market without taking on market risk? It sounds a little too good to be true, right? Well, let's pop the hood and break down the engine of an FIA.
So the absolute core promise here is principal protection. And this diagram shows the key difference. Your money isn't actually in the stock market. Instead, the interest you can earn is just linked to a market index like the S&P 500. So what does that mean? Well, if the market totally tanks, like you see on the right side there, your original investment, your principal, is safe. And this is the magic number, 0%. The absolute floor is 0. So let's say the index it's linked to has a terrible year and drops 20, 30, even 40%. The interest credited to your account for that period is simply 0. You don't go backwards. You do not lose your principal because of a market downturn. That is the fundamental guarantee. Okay, so that immediately brings up the next logical question, right? If you're totally protected from losses, how in the world does the annuity actually grow? Where does the upside come from? And let's be honest, what's the catch? Because as you might guess, the growth isn't unlimited. All right, so this is where the trade-offs come in.
To get that downside protection, you have to agree to some limits on the upside. The research calls these governors. The first, and maybe the easiest to understand, is a cap rate. And it's exactly what it sounds like. It's a cap, a ceiling on your returns. A great way to think about it is like a speed limit for how fast your money can grow.
The next governor is something called a participation rate. This one defines what percentage of the index's gain you actually get to, well, participate in. It's another lever the insurance company uses to manage its own risk while still giving you a slice of the pie when the market does well. And the third one you might see is a spread. This one's pretty simple. It's just a percentage that gets subtracted from whatever the index gained. So these governors, the cap, the participation rate, the spread, that's the trade-off. That's how the insurance company can promise you that 0% floor. Basically, you're trading away some of the potential home runs in exchange for a guarantee that you'll never strike out. Okay, so that's the theory of how it all works. But the real question is, how does this actually stack up in the real world? Well, the source material ran some really interesting historical simulations to find out. So let's take a look at the data. Wow. Okay, this chart right here just visualizes the whole concept so perfectly. Look at the bar chart for bonds. Over the entire study period, long-term government bonds actually lost money about 13% of the time. Now, look over at the simulated FIA on the right. See any bars below zero? Nope. 0 periods with negative returns. That is the 0% floor in action. You can literally see the risk being taken off the table.
So then the analysis went a step further. They ran a simulation to see what would happen if you took a classic 60-40 portfolio, 60% stocks, 40% bonds, and just swapped out the bonds for a simulated FIA. And the results are pretty fascinating. Over a 90-year period, the portfolio with the FIA actually came out with a slightly higher average return. And you can see it really shined in those periods when bonds were underperforming.
Now, of course, there's no magic bullet, right? No single solution is perfect for absolutely everyone, and FIAs are definitely complex products. So, to wrap up, let's take a look at the complete, balanced picture that the source material presents.
And I appreciate that the source really lays out the pros and cons very clearly. On the plus side, you get that powerful principal protection and tax-deferred growth. But, and this is a big but, there are absolutely significant trade-offs to consider. We already talked about how your gains are capped, but it's also crucial to know this is not a short-term product. There are things called surrender charges, which are basically hefty fees you'll pay if you need to pull your money out too early. And that really speaks to the limited liquidity. It's not like a savings account where you can get your cash whenever you want.
And just to make sure everything is crystal clear, the material also takes a minute to bust some common myths. I think the most important thing to grasp here is understanding what an FIA is and what it is not. It is not a direct investment in the stock market. It's an insurance product. It's a very specific tool designed for a very specific purpose, and it's meant to be just one piece of a much larger financial plan. So it all comes down to this one final question, a question for you to really think about. In a world where the financial landscape is constantly shifting, where the traditionally safe assets are facing brand new challenges, does it make sense that maybe the tools we use to map out our journey to retirement should change too? It's definitely something we're thinking about.